I thought we might start somewhere completely away from small caps and go and look at one of the greatest products of all time. Now, I'll give you a hint. This is not a small company. This is not an unknown, undiscovered product. Since this product was invented, $1.8 trillion of sales and over $500 billion of profit. I'll give you one more hint. They released the new version of this product yesterday, which is pretty much exactly the same as the version before, and the version before, and the version before that, right? So it's the iPhone 16, and this is the iPhone, potentially one of the greatest products of all time, if you discount cigarettes. Let's just not talk about tobacco in a purely financial sense. But what's interesting about the iPhone is when they introduced it back in 2007, it was thought that they were introducing 3 products at the time. So this was when Blackberries and Nokias were the sort of smartphone leaders, and Apple came out and said, we're introducing a widescreen iPod with touch controls. We're introducing a revolutionary mobile phone, and we're introducing an internet communicator. Widescreen iPod, mobile phone, internet communicator. People thought they were introducing 3 products, but of course we now know that their insight was we could put all 3 of those into one device, and many more since then, and that became this terrific success story. So that's where I thought we'd open, the story of the iPhone.
But what on earth does that have to do with investing in small caps? So what we're looking at here is 3 real-world small cap funds in pure alpha terms. This is their net excess return over the benchmark over the period of time that you can see on the graph. So you really do want to be invested in active small caps over the long run because the excess returns that they offer over that long period of time are real and persistent. 30 years of Morningstar data shows that the median active small cap manager in Australia has returned 12.6% per annum. And you really only want to be with a manager in the long run who's going to generate an excess return that's over the benchmark because benchmarks are so cheap to invest in. Now, if you look at this fund performance over time that we've shown up here, you notice that there's a very wild ride over time in all 3 of these small cap managers. And that alpha journey is sometimes very testing for even the most patient of investors. Now, we think that there's a couple of reasons for this wild ride. Firstly, most funds in small caps do concentrate, and in a very volatile part of the market, we are creating very concentrated portfolios. And secondly, we often couple that with a style bias. Not all funds, certainly not the ones that you'll hear from today, but many funds only focus on one part of the market. You see this pattern of returns from a core fund or a value fund of a growth fund that's really inconsistent over time as a result. And we know that this creates difficulty for financial planners and their clients to stay the journey and to stick with their small cap managers over a long period of time, despite those terrific long-term returns that I mentioned before. And we also get spooked from the volatility of the returns in this wild ride. Now that was just 3 funds that you can get today, a core fund and a value fund and a growth fund, but here are 3 more, core, value and growth, and 3 more, and 3 more. So you see very different journeys depending on the managers because of that wild ride in performance through time. Now, we've met hundreds of financial planners over the last 5 years, and up here on the slide is just some of the concerns that they've expressed to us that make it difficult for them to stick through that journey of small caps and access those higher returns for their clients. And I'm sure some of you in the room would recognise some of these quotes. Now, the answer might be to invest in multiple small cap managers and to try and blend out that volatility, maybe, but that creates portfolio construction difficulties and cost difficulties in your clients' portfolios. So how is Longwave different, and why do we do things the way that we do?
So we've tried to solve this product or this problem differently in the strategy you can see on the screen. And if you're to take away really one slide from what you see from us today, and you're going to see a lot of slides from a lot of great managers, this is the one that we would like to leave with you. And that is that the Longwave approach is built around trying to deliver more consistent alpha. So this chart looks at the same basis. It's this net alpha journey through time, but we're trying to smooth out that wild ride. We're trying to give more consistent performance, capture those long-term benefits of active small cap investing that we've already heard about today, and allow investors to stick with their small cap managers through all different market environments. So a small cap fund for all seasons. How do we do that? Well, we're different to a lot of other managers in how we put our portfolio together. We hold 115 stocks in our portfolio, which for most people immediately makes you think of, well, you've just diversified away all the excess returns. But with 8 years of running a highly diversified small cap strategy, we've shown that that's not necessarily the case. One way of thinking about how the fund is put together is it's like a core fund and a value fund and a growth fund all in one. So a sleeve of each of those styles blended together to a single integrated portfolio to try and capture the benefit of these long-term returns. What do we mean by core, value and growth? And what are some examples of that? Well, for us, core stocks are like strong franchises that have really competitively strong market positions, long-term growth, and they're not necessarily at bargain prices, but they're good anchors for the portfolio in terms of delivering those stable returns. And these are some examples of what we would call core stocks in our portfolio today. Value stocks look very different. Often they're out of favour. In many cases, you have to do a lot of digging to uncover where the value resides in the business. It's not obvious to the market where exactly the benefit is in holding one of these, depressed, turnaround, out of favour type stocks. And so you need to do a bit of work to find the upside there. And these are some examples of what we would call value stocks in our portfolio. You can see quite a few in the resources sector there, and we'll show you some numbers a bit later on to show you just how out of favour resources have been in the last couple of years in small caps. And then finally, growth stocks. As Greg mentioned, it's sort of the compounding category, the obvious compounders that most people want to talk about in this market environment. For us, our definition is companies that are proven. So we're not playing in speculative thematic stocks. That's not the part of the market we're interested in. It's proven growth businesses that are profitable with a long runway. And these are some of the examples of growth stocks in our portfolio. And so we own all of the stocks on the screen at the moment in each of those buckets and more than what's on the screen. And we'll just drill into 3 examples to show you how our process works and where we're seeing opportunities in each of those buckets today. So I'll kick off with EQT Holdings. EQT probably better known to everyone in the room by their trading name, Equity Trustees. And Equity Trustees are one of the dominant players in the outsourced responsible entity market. Now, only 10% or so of the market is outsourced. Many other firms insource their RE requirements. But if you run a public offer managed investment scheme, you need a responsible entity, and you're probably going to end up with either EQT or Perpetual. They dominate that market with 90% market share between them. Now, market structure is a really important determinant of how well a business can do through time, mainly because it gives them access to pricing power. So if you don't like the price that Perpetual is giving you on your RE services, my guess is if you go to EQT, they're not going to do a much better deal. It's a very consolidated industry. They have pricing power, and in our forecast of 10% per annum revenue growth over the next 5 years, a big chunk of that will come from their ability to pass on prices. That could be unexpected inflation that we've seen the last few years, or it could just be management pushing prices up ahead of inflation. What creates this kind of core return profile in our portfolio, in this business in particular, is a revenue profile of about 10% per annum over the next 5 years. Added to that, the ability for them, in our view, to grow revenue faster than costs, which equals operating leverage, and that results in EPS growing at about 13% per annum. And because this is a very capital light business with very little need to retain earnings for reinvestment, they can pay out a lot of those earnings, which are there in cash, as dividends. And so long as they hold on to their PE multiple between now and mid-cycle, or 2028, we think that the total return of around 17% will be about that stack of revenue growth into EPS plus the dividend yield. So that's a pretty good return. It's a pretty stable return. And if they stick to their knitting and stay in their core markets, it's likely to be an unsurprising outcome for us as investors holding that business.
So what about a value stock? I'm going to talk about Macmahon's next, who are a mining service provider in above ground and underground mining. But before I do that, I need to talk about the mining services industry. And we have to go all the way back to 2014 at the end of the mining boom and look at what the industry looked like back then. It was a mess. There were dozens of competitors in the market, and they were all competing for work from mining companies that were seeing commodity prices roll over and their businesses under huge pressure and in decline. And with all that competition and that fragmentation, it was a low and returning business to be in as a mining contractor. It wasn't a great business after the mining boom, and in fact, a lot of them ended up in a lot of trouble. 10 years on, the industry is consolidated, and it's now limited to a handful of players. And with that, there's more discipline. The prices that they bid for work are better, and the returns that they can generate are also better. Now, Macmahon, NRW and Parenti, who are all listed and are there on the right-hand side in that consolidated industry, have all been active in the consolidation of this industry and are in our portfolio. Now, what about Macmahon? As a result of that, what we're seeing with Macmahon is a business that's going from a low and volatile 8% return on capital to a more sustainable 15% return on equity. So why is that a value opportunity? And why is it a value stock? So for a lot of this period, Macmahon was trading at less than half of book value. That's the plant and equipment that they use to deliver the services into their clients, and you can sell that on the open market. About a year ago, we could see that the industry was still consolidating, the returns were still improving, and the stock was still trading at less than half times book value. To us, it was a clear value opportunity, and we took advantage of it, and it's still in our portfolio today. Now, what about a growth stock? I'm going to talk about RPM Global here. Now, this is a software business which is focused on the mining industry. They build enterprise-class software for Tier 1 mining companies to manage all parts of their mining processes in the pit, including managing those of the mining contractors that I've just talked about. They have invested $200 million in R&D over the last 10 to 15 years, building out products, and they've seen many years of strong revenue growth in recurring SaaS-type software revenue in their business as a result of this. But what about the future? We think that revenue will continue to grow, and you can see our forecast there in teal in that chart. Even though RPM have been in the market for a long time, they still are less than 25% penetrated into Tier 1 miners, and they have very little competition in this type of software for the BHPs, Rios and Anglos of the world. And as a software business, if you think about them like you would think about Microsoft Office and all the different products that you use from Microsoft, RPM Global are the same. They have a number of different modules that their clients can buy and tack into their in-pit mining software that they already have from RPM. But less than 7% of customers use more than one product from RPM. So as a growth stock for us, RPM Global is a great example of a business with a niche in mining software, which is very, very defensible, and a very long runway of growth to come globally. So that's how we think at the stock level about what makes up a core investment, holding a value opportunity and a growth investment with a long-term runway.
So I'll just spend a couple of minutes giving a quick reporting season recap as we saw it, and then we'll leave it there. But a couple of points to note. So on the left-hand chart, the thing that was interesting to us, that's the 12-month returns to the end of reporting season. You can see in small caps just how much industrials versus resources have diverged. So 14% in the past year. If you go back over 2 years, it's almost 25%. So, there's probably a lot less attention given to resources now, probably much more value-driven, but these things move in cycles. So that's interesting to see just how much that's underperformed. And even though we're kind of veering out of our lane a little bit, talking about large caps, what was interesting to us was when we ran the bar on the far right, the ASX 300 X banks, actually small caps have done pretty well relative to all the other parts of the market other than banks. So, banks really are a big part of that large cap story, and that has come through in those returns. In terms of the EPS revisions on the right, so these are the revisions to earnings expectations we saw through reporting season. In teal, you can see the different indices. Small caps didn't have a great period. In fact, earnings revisions were negative across the board. Let's pick sectors. So financials did better. Let's say consumer discretionary did worse. How should we think about this? How should this feed into our process of how we make investment decisions, and does this sort of top-down view of what's happening to earnings matter? Well, we would argue in small caps, nowhere near as much as you think. And this is why. Every year in reporting season, we show these charts and we look at the divergence between the winners and losers. And in the small cap market, well-run businesses with competitive advantages and well-executing management can, in an industry where there is no growth, and in the last couple of years there's been pretty much no growth in retail, they can do well. They can do well by executing their business plan, by taking market share. In the case of Universal Store, in the past 9 months, they've grown their expected forecast earnings 30%, while KMD Brands, which is Kathmandu and a few other brands, has seen their earnings expectations decline by 50%. So we always think in small caps, the bottom-up business level analysis matters far more than taking the top-down macroeconomic views and trying to build portfolios or find stocks that fit. And one more example here in financials, remembering that financials is one of the better performing sectors. We have GQG Partners earnings expectations up 50%, Platinum down 25%. So we think there's always opportunity to find winners and losers in small caps, away from simply letting the macro dictate where we should seek those opportunities. So that's Longwave. That's how we try and build portfolios that are all-weather portfolios, small cap investing for all seasons, not just reporting season, and we're trying to build more consistent alpha at lower fees into client portfolios. Thank you.